So now I'd like to introduce me. It's going to be a somewhat different paper than you've just seen. This is a paper we call, this is going to be deadly, Informed Trading and Its Regulation. And so this is done with Merritt Fox, who's a professor in the law school, Gabriel Rauterberg, who is a visiting scholar in the law school as well. And this is a more law journal sort of paper. It tries to draw some policy conclusions from thinking about the costs and benefits associated with different types of informed trading. And so I'll sort of talk about those costs and benefits and try and think about specific situations in which we can apply that analysis. And then maybe on the fly, because Yasuchi's been out of town for a while, I'll try and apply our analysis to the situation that he described. Again, it will be based on my knowledge of US law, not Japanese law, about which I know nothing. But okay, so what do I mean by informed trades? And you probably have an intuitive notion of what that means. We sort of have in mind this notion that the price embodies some amount of information at each point in time. And we think of an informed trade as being a trade that is based on information that allows a more accurate appraisal of the stock's value. And that appraisal is different than the appraisal of the overall market. You can think about it in terms of alpha, in terms of investment returns, that informed traders are the ones who do successfully, on average, buy low and sell high. They buy low when their appraisal of the stock is that it should be higher, and they sell when their appraisal of the stock is that it should be lower. And so you can either think about it from an informational point of view or from what they earn. Now, what are the sources of these informed traders' more accurate appraisal of what the stock is worth? Well, it could be a number of different things. There's the sort of classic equity analysis in which someone gathers numerous bits of publicly available information and puts that together via astute analysis to just come up with a better appraisal of the future of the firm. If we have to go down to the level of the core, they figure out what the expected future free cash flows are going to look like, and they discount it with the appropriate WACC. And I'm teaching 3 sections of the core now, so I'm all wrapped up in that. But I think that's sort of the way we think about classic equity analysis. And we can think of those as informed traders. Informed, and possibly just by public information, but I think we want to take into account this sort of astute analysis component as being potentially very important. We can think of fast traders. So there's information that's public, but they're able to trade on it faster than anyone else. And so with the classic high-frequency traders come to mind. That could come from non-public information from within the issuer. So this is the sort of thing that Yasuchi was talking about. It is the thing that typically insider trading rules would have something to say about. It can be non-public information from within some other institution who may or may not have a relationship with the issuer, that is, a relationship with the stock about which there is information. There are a variety of rules that have an impact on informed trade, and rules that prohibit, deter, allow, or encourage particular kinds of informed trading. And I'll just point out the major ones. Rule 10b-5 is typically the basis for an insider trading violation. It's an anti-fraud law. There are the forms that firms send to the SEC. That is a regulation about the kinds of information that issuing firms are required to provide. Reg FD, Yasuchi's already talked about that if the company wants to make any announcement to anyone, it has to make that announcement to everyone at the same time. Reg NMS actually major revision to the 34 Act, talks a lot about the provision of information, in particular information about quotes and information about transactions. And then there are rules at the state level and various stock exchange rules concerning announcements and trading halts. And so if you think about overall the regulation of informed trading, you see that actually illegal insider trading is a pretty small part of the overall regulatory structure that has an impact on informed trading. So what is the objective of all this? We're trying to figure out which kinds of informed trades are good and socially desirable and which are socially undesirable. And consider the best way of regulating the market in order to minimize the bad stuff and maximize the good stuff, minimize the costs associated with informed trading, maximize the benefits. Are we completely successful in that? I would say not, but we are starting the discussion about what the issues that should be on the table. Now, let's think about overall what are the distributional effects of trading based on superior information. Top line, informed trader wins. Actually, that was almost part of my definition, is that the informed trader buys low and sells high. And you do that a lot, and that's a really good thing for you. However, of course, trading, as opposed to investing, trading is a zero-sum game. So if someone profits from the transaction, the opposite side loses from that transaction. And so that is where the wealth distribution effects come into play. So let's use a simple example, and you can see that the slide changed, and that means I ripped it off from Merritt Fox. So we can think about three players. We have the informed trader. We have uninformed traders. Nice formatting there. And we have liquidity suppliers. And what do I mean by liquidity suppliers? Actually, in some ways, I'm talking in part about the high-frequency traders. High-frequency traders do lots of things, but one of the things that some of them do is they want to buy at the bid and they want to sell at the offer, and they'll stand ready to do that all day long. It sounds like they make a half penny per share on every transaction. They don't, and why? Well, I'll get into that in just a moment. And it mainly, well, I'm getting into it now. It has to do with the fact that when they're buying at the bid and selling at the offer, sometimes they are buying at the bid because there is an informed person that is selling to them, and they're going to actually lose because remember, the informed guy wins. And sometimes when they're selling at the offer, they're doing so because they're buying from someone who has information. Again, the informed guy wins. Okay, so first level is from these informed traders, the liquidity suppliers lose because every time an informed buyer buys at the offer or sells at the bid, he has bought at a price that is too low from the point of view of the market maker, the liquidity supplier. Every time he sells at the bid, he's selling at a price that, from the point of view ex post of the liquidity supplier, is too high. And so, as a consequence, liquidity suppliers don't just stand around passively, they do something about that. And so, what they'll do is, with the greater prospect of informed trading, they will say, all right, I used to be willing to buy at 11 cents and sell at 12 cents because I think there's a heightened possibility of informed trade. I'm going to not buy at 10 cents, I'll buy at 9 cents. I won't sell at 11 cents, I'll sell at 12 cents. They'll widen the bid-ask spreads to try and protect themselves from trading by these informed individuals. So how does that work? Well, we got uninformed traders, we have informed traders, and that's the great thing for the liquidity supplier. If he had nothing but informed traders, there'd be no bid or offer at which he or she would be happy to transact. but there are people running around there, like me, who occasionally buy and occasionally sell. Guaranteed, I don't have information. I'm willing to pay the spread, no big deal. I'm invested for a long time, actually at my age, not so for so much longer, but when I was 30, it seemed like an awfully long time. And so paying the bid-ask spread doesn't bother me too much, and that's the protection that the liquidity supplier receives. So, the price the uninformed pay generally is going to be discounted. Think of the following mental experiment. You've got two otherwise basically identical stocks. One's really liquid, trades all the time at a very narrow spread. The other is very illiquid, doesn't trade very much at a very wide spread. Which would, if they're both priced the same, which would you buy? Yes, you'd buy the liquid one. That sounds better to you because you'll be able to get in and out of your position very easily. Well, okay. But there has to be some demand for this illiquid stock, and so the price for that stock has to drop relative to the price for the very liquid stock. So we think, quite reasonably, that liquidity is going to be a factor in determining the price of the security. Okay? So we have illiquidity due to informed trading. This represents then a discount to the price level of the stock. And so ultimately this illiquidity induced by informed trading goes back to the original issuer at the time of the IPO. And you say, why'd you go through all of that? Well, I went through all of that to suggest that this thinking about the importance of informed trading is not really a fairness issue. It really is an efficiency issue. That think of two environments, one in which we regulate the trading based on private information severely, and so everything's really liquid. It's really easy to do an IPO at a high price versus an environment in which we do nothing about the regulation of informed trading. Everyone knows that in the future everything's going to be illiquid because of that. You can only do an IPO at a low price. More entrepreneurs are going to choose not to do that IPO rather than to just to hold it, make it privately held. And so ultimately that's going to then affect the allocation of capital, et cetera, and have efficiency results. So basically I think of the regulation of informed trading as not regulating fairness, but ultimately regulating efficiency. Okay. So I said I've sort of so far talked about kind of the negatives associated with informed trading. That is, it tends, other things equal, to make things less liquid. Why? Because if there's going to be a lot of unformed trade, our liquidity suppliers protect themselves by widening the spread. But informed trading can have beneficial aspects as well. Observation. The more accurate share prices lead to more efficient allocation of capital. We can figure out, with more accurate prices, we can see where we should be investing more, where we got positive NPV projects. And it also allows more accurate share price, allows for more better corporate governance. The price being more accurate reflects the actual decisions that executives are making, and that allows corporate governance to work more effectively. That leads to better allocative decisions. Okay, so we have the two sides. We have informed trade, increasing share price accuracy. On the other hand, informed trade, decreasing liquidity and increasing the cost of capital. Okay, so we got a positive thing and a negative thing. This is what economists love, trade-offs. Okay, so we have informed trading making share prices more accurate, and the negative part is informed trading making trading in the shares less liquid. And so the desirability of any kind of informed trade is going to have to depend upon the trade-off of, do you think the positive allocative efficiency is more important, or do you think the negative liquidity is more important? Okay, so this is the overall framework for trying to think about the regulation of informed trading. Okay, so maybe we can start thinking about, well, what are the various types of informed trading we might worry about? And I'm going to go back to the fundamental value informed trading. The equity analysts collecting lots of bits of information and using the sophisticated analysis. And the empirical studies basically say that this trading on such kinds of information, trading based on equity analysis, plays a significant role in information getting into the prices. The prices are accurately reflecting all the public information that's out there. And so this has, you have lots of equity analysis that may have liquidity effects, but there certainly appear to be very important allocative effects as well. And actually, the public goods nature of information, the fact that obtaining information, processing it well, coming up with an accurate share price benefits the producer of that public information. They have trading profits. But the benefit of that is even wider. It leads to better share prices, more allocative efficiency. So there's a sort of public goods aspect, and we would expect other things equal to be underproduced. So we would conclude from all of this that this kind of informed trading based on equity analysis, the share price accuracy probably dominates. This should come as no surprise. It is not illegal for equity analysts to collect information and trade based on that information, or provide that information to someone else to trade. We see no result of it. Is there some small trade-off? There probably is, because at any point in time, equity analysis is always a possibility, and it is something that our liquidity providers need to worry about. We probably see slightly less liquidity. Okay. Announcement trading is another kind of informed trading. So based on announcement, public announcement, the issuer, during some brief period of time between when it is officially announced and when it gets broadly sent out to the public, we can imagine some high-frequency traders being able to trade on that information. Are they informed traders? They are informed traders. Do we see any allocative efficiency from that? No, not so much. What it means is that if it's a public announcement, it will get into the price in the next couple of seconds. Instead, we're going to get it into the price because of the activities of the high-frequency trader. Now, there's no benefit to that. Probably has a harmful effect on liquidity, consumes scarce resources. Though actually there's going to be one example of this in which we're going to say, no, it shouldn't be regulated against. Okay, how would we deter this announcement trading? There might be rules to not only Reg FD rules which say who you can announce to, but also rules about when you can announce. If the equity markets, all right, in some sense the equity markets are never closed, but there is an official opening time at 10 o'clock in the morning and then the closing time at 4:30. And so outside of that, there's far less liquidity. So we could require announcements outside of trading hours. The liquidity providers have nothing to fear. Maybe we could, there's some structural rules. It seems to me the easiest ones is just to steer announcements to off hours. It's hard to imagine that allocative efficiency is altered by having an announcement at 2 o'clock in the afternoon rather than 5 o'clock in the afternoon. Doesn't make a difference. Okay. Informed trading by issuer insiders. So here the social value is likely to be minimal. After all, they're not creating information. The the legal insiders, in that they're senior executives or insiders in terms of their holdings of stock. The trade is when a insider trade is based on material information, that information is likely to be very soon in the future. We don't materially change the share price accuracy. Okay, so there's a whole literature that says management could be compensated based on allowing them insider trading privileges. And so the idea here is we don't give you stock as compensation. Rather, you make a good decision and then you can trade based on prior to that decision and make a profit, and that's your compensation. It's just kind of outrageous, and I won't go into all the arguments by why that doesn't work. My counterexample is always, yeah, actually could work, that the manager makes terrible decisions and then shorts the stock. That would work. Maybe it wouldn't. Okay, so probably that means the trading on material information by issuer insiders should be prohibited as it is. And again, to be clear, this is based on an analysis of the economic costs and benefits, not on whether or not it's a fraud, not on whether, or, which is the basis of 10b-5, not on whether or not it's fair. It's rather based on the economic consequences. Okay, trading by insiders of institutions other than the issuer, and you can think about a potential acquirer and its investment bank, institutional investors, research firm. In this case, the institution itself could be a fundamental value informed trader, and those trades could be deemed socially desirable. Institutional insiders and persons, we come down to believe, privately receiving information from the institution should be allowed to trade if they have the institution's permission. That's unlike issuer insiders and their tippees. Based on this, I wonder, based on US law, I wonder whether or not the traders that Yasushi talked about are in fact doing illegal insider trading. A classic example of something that everyone thought was insider trading but the courts did not was the Mark Cuban case. This was a case that was brought by the SEC of insider trading. Mark Cuban, as you might know, is the owner of, I can't remember which team, but someone must know. The Dallas Mavericks. Mavs, okay. And so he had a position in a firm. The CEO called him up and said, we're going to do a new round of financing. It's actually a PIPE financing, a private issue of public equity financing, not typically thought to be good news about the firm, and asked Mr. Cuban if he'd like to participate. Mr. Cuban said no, he wouldn't participate. He hung up the phone and sold all his holdings of the stock. Was this illegal insider trading? In the end, it was deemed not by the courts. He was not found guilty of insider trading for two possible reasons. One, there was real question as to whether or not the CE did or did not say, Mr. Cuban, I'm telling you this information confidentially. You are not supposed to do anything about it. It was not clear whether that was said or not. The other interesting thing about this is when this announcement came out, was made public, the stock dropped by about 5%. This is a daily drop. It turns out the volatility of that stock was so great that a 5% change in its stock price was not deemed material. So there were two ways in which it didn't work out. So, should we allow institutional trading based on this information from the firm? In fact, I think we do allow it, as long as there's permission from the issuer. And that raises another interesting question with Yasushi's sample. It looks to me like the issuer was giving permission for trading upon the information that they were giving to the Nikkei early. So is this going to be illegal insider trading or not? It will be interesting to see. Okay. I have a meeting at 3, or at 2. I'm going to rush this along and get out of here. Okay. So I just thought I'd talk about 2 interesting case studies. You might have heard about this. The Michigan Consumer Sentiment Survey comes out with an index once a month. Formally released by Thomson Reuters at a known date at 9:55 a.m. Bless you. 9:55 a.m. in the morning. From 2007 to 2013, Thomson Reuters sold early access to this index, and that was received at 9:54:58 a.m. That is 2 seconds before the public release. This was first, to my knowledge, first picked up by the Wall Street Journal in, I think, sort of March or April in 2013. It was reported that there was this market for the early release of the insider information. Our Attorney General, Mr. Schneiderman, went berserk and said, "This is insider trading 2.0." And it forced Thomson Reuters to suspend the practice in June of 2013. And then University of Michigan signed a contract with Bloomberg in October of 2014. A contract which did not feature early release of the information. Now, what was the effect of the early release of the information? This is sort of interesting. So, this is a paper by Hu, Pan, and Wang, who are, Pan and Wang are at MIT. And so they got data about what happened in the E-mini futures contract trading at around this time. And what they discovered is the high-frequency traders received this information and they reached the price in about 200 milliseconds. Stunning. And I mean, reach the price in that if you take the price at 9:54, 58, and 200 milliseconds, and then ask what was the average price change 5 minutes later, the average price change was 0. They nailed the price. Okay, so what's the value of early peak? Well, certainly information gets into prices faster. By how much faster? 1 second and 800 milliseconds. Great, fabulous. So no, that's not a value. However, here's an interesting aspect of this. People generally think that the Michigan Consumer Sentiment Survey Index is a useful bit of information, and actually it's more than just the index. It's a whole collection of facts about how consumers think about the economy. We think that's probably valuable. Might it have been that because Reuters had contracts with these high-frequency traders to buy this information early, it's a little bit hard to figure out how much they must have paid because it doesn't seem like it was worth very much given that the information was resolved in 200 milliseconds. But they did pay something, and some part of that might have gone to the Michigan survey. So that is the value of the early peak, is that this went to the production of information that most people consider to be value. Cost? Actually, virtually none. I've talked to people who were in the markets, and basically what they said is when the Michigan Consumer Sentiment Survey came out, we knew it was going to come out at 9:55 in the morning. We're typically a liquidity supplier. We just backed away at 9:54, 50 seconds, and stayed away for 2 seconds, and then came back in. And so whether there's a great cost to liquidity providers, it doesn't appear there was. Our conclusion, no problem. Maybe there was some benefit to this, not apparently any real cost. So is it, Mr. Schneiderman can call it insider trading 2.0. It isn't. Case study 2. If you look in the data, and this is by Irvine, Lipson, and Puckett, you find an interesting increase in institutional buying 5 days before there's an analyst upgrade. If you go from hold to buy or sell to hold, and there are more degrees than that. So this is interesting. What are the institutions getting this information from? The evidence is that the analysts actually had their favored clients and that they told them about this. They told them that there was going to be an upgrade announced 5 days before. First of all, to be clear, this is not illegal insider information. The equity analysts gathered the information that led to the upgrade. The information belonged to them. They can do whatever they want with it. So from a legal point of view, there's no question that it's legal. The only case where it's illegal is if the analyst firm says, we don't give an early peak. And if they do give an early peak, then that's a fraud, and Merrill Lynch was fined a lot for doing it. Otherwise, they can do it other. So, tipping, should it be banned? Well, let's apply our format for thinking about this. It increases price accuracy 1 to 5 days earlier. So what? Since timing of the upgrades are not predictable, so in the case of the Michigan Consumer Sentiment Survey, our liquidity providers could back out of the market because they knew they might be nailed by people with information. That's not so the case here. So this could be sort of a constant source of cost to liquidity providers. So we should probably see a reduction in liquidity associated with that. On the other hand, it does reward the institution for generating the information. It rewards the institution for generating information that, from a public policy point of view, we have deemed to be just fine. We think equity analysts are important for increasing share price accuracy, and so the negative effects are going to be no different from the institution itself trading on that information, which we have deemed to be perfectly legal. Or put another way, we have deemed it to be the case that the social benefits of this information-informed trading outweigh any sort of costs. Conclusion, no problem. I'm not going to talk about Yasushi's case. So that's sort of what I have to say. A plug, if you're interested in this and other capital market regulations, look out for B8326. It's a course I co-teach with Merritt Fox over in the law school. Mostly law students, but we get a smattering of MBA students. If it's your thing, let me know.